Yeah.
Hi everyone, thanks so much for joining us today. Sorry for the bit of delay, we had some technical difficulties. And actually just before that we had a fire alarm in the building, so we had to evacuate. So we're just getting back on track. Nothing like starting our day with a little bit of excitement. So thank you so much for joining me today. I thought I would ask my special guest and one of my colleagues, Darrel Hitchcock. So Darrel is our mortgage specialist. And the reason I asked him to join me today is because I wanted to talk about credit bureau and the importance of having good credit, building good credit, what it takes to get good credit, how to keep good credit, what not to do, sort of the good, bad, the ugly when it comes to credit bureaus. So he's the expert, so I thought we'd have a conversation with Darrel about different things he can do to boost your credit score and how to keep it looking great. So thanks again for joining me today, and
it's good to be here, honestly.
Thanks for being patient with our few little issues over the last few minutes, but let's just jump right into it. So I was speaking with actually a client 2 or 3 weeks ago, and her daughter is in her 20s, and she's just looking at building credit. So what would you, I guess, how would you explain to people how do you build credit and what's the importance of having good credit?
So to speak to, so thank you for having me, by the way. I'm kind of excited. This is a new adventure for me. For those of you that are watching, Krista's a seasoned veteran now, and she's been at this for a few weeks. I want to say maybe even a couple of months. So
a couple of months live streaming.
This is fairly new for me, new adventure, and I'm really excited about it. Just the opportunity just to have a conversation about credit, and so I wanted to say thank you for having me on the show, and
very welcome.
I hope you folks find this information valuable and useful, and certainly we're here to provide some tips, if not anything else, some information for you. So again, thank you. So I think that in terms of why somebody would want to have established credit, or why you would want to focus on or try to establish a good credit record, an example or a few examples, I'll give a few examples of why you might need to have credit or good credit. So for example, an insurance company, when you're looking for fire insurance or automobile insurance even, some companies will actually do a credit check. Common would be a cell phone company.
Yeah,
they do. We also have places where you're renting. There are a lot of rental companies that do credit checks, and I think the purpose of that is just to establish that you're working and you're not a high risk to fly away, kind of thing. So, and then you have your traditional, I'll call them banks, financial institutions, lending companies, including credit card companies, which most banks are involved with. So they'll also be very interested to see what your track record is all about. So I think that there's a number of reasons why you would want to have a credit record. So if you're looking to purchase a vehicle, purchase a home, which I personally love, so it's very, very valuable to have that track record for the bank to pull on, or other companies.
And actually, it's funny that you mentioned that, because I wouldn't have thought of all the different types of companies or reasons that they pull credit bureaus. But even for my current job that I have with IG Wealth, when I joined this company, it was part of the hiring process was to do a credit bureau check. And sometimes you forget how important it is on a day-to-day basis of having good credit. So what kind of goes into, for somebody who's just starting out, or somebody who's looking to build credit, whether they're in their early 20s or late teens, or perhaps somebody who's new to the country, what steps should they take to build it, and how do they do that?
So I guess the simple answer for that, in terms of establishing credit, so remember that all the companies that are looking to give you money want a track record. So where do you begin, I guess, to who is it that you need to go to? So without mentioning any particular companies, the traditional path that most people will take, and just with my limited knowledge on the subject, I've dealt with it for a number of years, but based on what I see and what I would recommend would be, there are companies, if you use Google, traditional search method, there are companies that will lend you the money with a security. That's typically required. So perhaps a secured credit card, right? So you put the money aside. The company holds that money to offset the risk of giving you a chance, right? To establish yourself. So you would typically see that if you handle that well, you would see that last for 6 months, maybe a year. And then you can go the more traditional route at that point. Perhaps a bank could lend you some money, or you go to the regular credit card that's not secured. So,
then you graduate to the unsecured,
and you get into
unsecured credit.
With the big boys and girls. Yeah, you graduated credit high school,
right,
so to speak. So I mean, what it does is, I guess, it essentially, once you get your foot in the door, typically the path is through a secured product.
Okay, which makes sense.
Yeah.
And then, so what kind of goes into building a good credit score? So somebody that has limited or they have some credit outstanding.
Yes.
So how do they build that good score? Because that's often a misconception among a lot of clients that I've had present and in the past.
Yep.
They assume things which may or may not be correct. So let's chat about what goes into a good credit score. So
my answer for that would be fairly basic and fairly simple. There are a number of what I'll refer to them as categories. So in terms of categories, one that I would reference would be utilization. And what does utilization mean? More or less like a score. The old grading system in school, Krista, I think they used to give an actual percent, right?
Okay.
So I know now they use numbers 1 to 5 or something like that, or A, B, and C, or those type of things. But credit companies are now using a utilization. It's a score 0 to 100%. So what does that mean? For example, we talked about obtaining that credit card deal, albeit $1,000 limit, and Krista, you go out and make some purchases. You go shopping. We won't say where. Maybe perhaps across the border, and we go a little overboard and we spend $900. You would be marked if you carry that $900 balance. If you carry that, you're at 90% utilization, which is a percentage of what you have access to and what you've actually used. So utilization would be the usage.
So I don't have a lot of room left
on
my card.
Correct.
But I had fun shopping.
That's right. Which I don't know. It depends on what's more important to you. So,
I was going to say.
And if we go back to like how are we looking to establish a good track record or a good credit score, utilization is heavily weighed in the decision. So there are other categories like revolving credit. So revolving credit is just the ability to go back to that account. You can use it and pay it and then go back and use it again. So the traditional would be lines of credit with banks. It could be a credit card, of course, right?
So just going back to utilization for a second then.
Sure.
So what would be the ideal, so if I have $1,000 credit card, what would sort of be my target percentage? We said 90% would be high.
90% would be much too high.
Which would not help your credit score.
Correct.
But is there like
a magic number?
Probably not a magic number.
I don't really know if there's actually, I would just say in a ballpark, I would say you would aim for 30 or less. Right? So in talking about that, some people would say, it would shy away from getting access to more credit. Sometimes it could be out of, not trusting yourself.
True enough.
Right? So some people know their limits, and that's a good thing. It really isn't the only factor for sure.
Right. So what are some of the other factors?
So if we had, and I was thinking about revolving, we started to talk about that. So revolving debt and utilization of it, they're graded differently because you have access to it. So certainly it's a more difficult product to get, right? So banks are saying that you have access to this money, not repeatedly, but you're able to go back and borrow it again. So there is obviously the risk that you don't pay off, right? Yeah, a little bit higher risk.
You change jobs or something happens, you get sick. Whatever the reason is, you may not be able to pay it back.
That's right, So a big one that I think it's a hot topic because it happens more often than not in my experience. And not a lot of people, I don't think, realize the impact of, and it's probably the biggest category would be credit inquiries. So,
yes.
yeah, it really is a hot topic. I have a lot of conversations with many clients and going back into my banking years as well. People, I don't think, realize sometimes what actually happens when somebody says, well, I'm going to do a credit check. And there's even cases where people aren't even aware of the credit inquiries. So,
No.
yeah.
So if I am, I'll just use myself as an example. When my husband and I moved back to New Brunswick, there's often a lot of credit checks.
Yeah.
So from credit inquiries from a bank or a financial institution, cell phone company, hydro company, vehicles, if you're purchasing one. Anyway, you can end up with quite a few inquiries over a short period of time, which is not necessarily good.
And perhaps could be avoided, could be unavoidable. True, right?
Some things can be avoidable. And I think one of the things that I've seen sometimes is where people will shop sort of bank to bank for a mortgage or a specific product.
Right.
And but it's one thing to shop for a rate, and it's another thing to shop and have a credit application pulled.
This is true. Yeah.
Right.
Absolutely.
So what does it look like from the credit bureau company if somebody like myself was going to shopping around and having credit applications at different financial institutions?
Correct. Yeah.
So how does that play into my credit score?
Yeah, so again, it's similar to the utilization and having access to credit. It's similar. It's a contributing factor, right? So how does that contribute? Anytime that a company pulls a credit report, they're actually looking into your track record that we talked about establishing earlier. So in order to do that, it actually detracts from the scoring system. And I think we're going to talk about that a little bit later. But in terms of the effect, it actually pulls on your score. And that's the way we look at it. It's a credit pull, right? So it's going to affect the score. So multiple inquiries is definitely a hot topic and definitely one of the ones that hits people the hardest usually. You can lose a lot of points on that and potentially could cost you more in interest, could cost you a job. We hope not, but you may not be able to rent somewhere or get your fire insurance, or the hypotheticals are numberless, but
one good credit.
One good credit. Definitely want good credit.
So one of the things, and I know, so when it comes to the credit bureau, and you touch on this, the credit bureau score itself. So just touch on, what does it mean to have like a beacon score? What is the most you can get, and what is sort of the average, and what do those numbers look like? Because sometimes I'll have clients come in and say, I know my score is 750 or 850 or 650. I don't know what that means. Is that good or bad?
Right. So in terms of credit score, I guess there's a change of terminology for specifically with one company. So it's no longer called a beacon score. They changed the name to FICO.
Oh, look at me being dated.
Well, I think that beacon score, actually, I catch myself all the time because it's only recent change. But anyhow, the way that the companies look at this, and I guess the way that we can summarize it would be, there's a scoring level, and the average range, I think, in Canada is 300 to about 900. I think the top score is 900. So again, on a grading level, our ideal would be every client at 900, or every individual, right? I mean, that's the ultimate goal, but to be more realistic, the desired range would be anything 700 or greater. The majority of Canadians are in that category. I want to say, I don't know the percentages or the numbers, but you want to see your score, I would say ideally 750 plus. If you're in the 700s, you're going to get the credit product that you're after if everything else lines up.
That's good.
So,
perfect.
And that's about the best I can do on credit score.
Credit score, no, that answers that question for me. So let's talk about what not to do. Because I think, we can probably come up with some good examples between the two of us of different things that we've seen over the last few years. Because I think between us, we probably have 40 plus years of experience.
Yes,
and
yes.
Let's just chat about things, because I think, it's, the credit score is, you want to keep it high, and there's some things that can bring it down quite a bit. So let's talk about those type of things. So perhaps companies, maybe you can talk about the different types of companies that would reflect on your credit bureau.
Yeah. So there's lots of factors to consider. So for example, your utilization that we talked about earlier, having a high utilization, we would have stuff like your maxed out credit, obviously, too many inquiries. So having multiple companies, like you talked about, moving into New Brunswick and having those companies hit the credit score. So really, you could create a perfect storm if you maxed out your bills and then moved from one side of the country to the other.
Right.
There's other things you can do.
Yeah.
Other factors to consider that we haven't talked about and are important would be personal records. So when I talk about that, that would indicate a consumer proposal or a bankruptcy. There's also the judgments, those types of things. So they're more serious items that obviously have a huge pull on your credit score. And then there's other items if things aren't that bad and you've made late payments or missed payments, or and then another example that's very closely related is being over limit. So because sometimes you get into a little bit of a trouble where you're not paying credit down. Perhaps you're sitting at $1,000 on that $1,000 credit card from the shopping trip. You are meeting your minimum payment deadline. However, with interest charges, you can actually hit over the limit. That might be a small amount, but that's a huge negative on your credit score.
And that would hurt me.
Yeah, for sure.
Yikes.
Yeah.
So one of the things that misconception perhaps people have is, so say for example, I have a $1,000 limit. I'm trying to establish my credit, and this month today I go out and buy a new pair of shoes and I put it on my credit card. Tomorrow I'm going to pay off that balance.
Yes.
Because I don't want to have a balance owing.
Correct.
So what type of impact does that have on us?
Well, I guess there is a lot of concerning information about that, and I would like to share this much, is that the credit card company is actually not going to give you credit for, and pardon the pun on the word credit, they're not going to give you credit for the transactional data. So basically what actually happens, and we'll talk a little bit about reporting, so remember we call it a credit report. So the companies that you borrow the money from and pay back, those companies are going to siphon data from all of their customers into the reporting agencies. And I'm not sure if we're allowed to talk about those agencies or not. We'll leave those out of this conversation.
We don't need to name them, but
that's right.
Two.
There's three.
Oh, there's three.
Well, maybe there's three. I don't know. Perhaps, so these companies are collecting this data from the places where you borrow your money, places that you pay the money back. And so those typically happen on a monthly basis. All different times of the month, by the way. But basically what happens, just in a nutshell, is they provide what your credit limit is. So you have the $1,000 limit on your credit card. They provide on the side, they're going to tell the credit bureau agency how much you have owing and whether you make your payment. Once a month.
Once a month. So for me, buying my shoes and then paying off my balance tomorrow doesn't really help me build my credit.
What I would say to that is that, again, they're not going to, just to give you an example, if I have a credit card account and I use it 50, 60 times a month, and I habitually charge it and go home and pay it right off, right? So if I do that on a regular basis, all that really is going to show up on your credit report is the day that your statement is issued, if you happen to have a balance at that time, and the fact that you paid it. Right? So it's not that it won't give you good credit, those transactions, but realizing that all you're going to actually get credit for is how much was charged, what your limit is, and did you make your payment.
So every month. So I'd almost be better off to buy my shoes wait for my statement to come in,
Mhm.
and then pay it off in full.
Yeah,
And then that will get reported that
Correct.
I paid it off in full.
exactly. And keep in mind too, the utilization that we talked about too.
Okay,
So always factor that in. So that being said, if you happen to use your credit card, we'll say excessively, we'll say a lot or frequently, what you keep in mind, if you have that $1,000 working limit, if you happen to charge multiple items and it gets to $600, there's no reason why you couldn't pay $300 towards it,
Okay.
so that when your bill is issued, you actually still you only hold about $300 balance.
Okay, good strategy
So,
on that.
just to keep in mind.
Yeah.
Not the exact science, but something along those lines. Yeah.
So how about the length of time that I have? So for example, one of my cards I've had for one of my credit cards, I think I've had about 20 years.
Mhm.
And what would happen if I was to close that?
So it's all about the credit history and the track record that we've talked about. And realistically, what I would say to that would be a huge negative on your credit score if you close that account, even if it's inactive. My recommendation ultimately would be to use that account, even if it's a limited basis, every so often, right?
Okay.
And
Yeah.
keep that record alive, because that's a 20-year history that you worked very hard to establish. And closing the account, you're removing that from your track record. Not it doesn't drop off, but it's not going to keep reporting on a month-to-month basis,
It's not gonna be
contributing to the
active.
overall big picture, right? So could actually come back to haunt you if you close that account, even if it's
Don't want to do that.
even if it's not used all the time, right?
Well, and it's funny because I'm glad I asked that question, because the card I'm talking about, I am thinking of switching it to a different credit card
Yes.
that has better benefits for me, better
Right.
travel benefits. But I didn't want to pay my annual fee on the one that I've had for
Yes.
20 years. But I
Gotcha.
suppose I could switch that
Mhm.
to a low fee account with them just to keep it open. It's not
Yeah.
going to cost me anything.
Yep.
Use it once in a while and then switch to something different.
Correct. So if you're shutting down one card per se, because the benefits aren't as high as the other bank, my recommendation in that case. So keep in mind that accessing a lot of accounts may actually be a deterrent as well. So you might want to consider maybe that 20-year record account. Don't close it, but put it into a no annual fee type of account.
Okay,
and maybe you talk about that company has given you a $20,000 shelf. Perhaps you could ask them to lower to $5,000. Right.
Okay, great.
So just overall, it's just about maneuvering the system a little bit. So
my last question before we go, we're almost out of time.
Okay.
We've talked a lot about revolving credits or credit cards, and likewise line of credit. Non-revolving, so term loans or car loans, how do they play into credit bureaus?
So they're a safer bet for sure, because they have an end date for the company that's giving you the credit, right?
Okay, so your payment, it's going to pay it.
It's a fixed payment, and keep it. It does actually contribute to the utilization as well.
Okay.
Yeah. So a newer account that you just got with your truck, you spent $50,000. You bought a new vehicle, a new truck, and you just got it. So that account will show as a high utilization.
Right.
So as you pay it down, you're going to get. You're obviously going to take full advantage of the utilization down the road.
Perfect.
Pardon the pun. Down the road on the truck.
Oh, too funny.
Yeah.
Any last thoughts?
Just that I was really excited to be here.
No, thanks for
and
coming.
I mean, certainly the credit is a hot topic. It's important to a lot of people. This can be working families, can be single folks, it can be business. Credit score really allows you the opportunity to leverage yourself.
Yeah.
Right. With a good credit history, you're able to put your best foot forward, and companies will love you for it. They'll hire you. They'll let you rent their apartment. They'll set up your insurance. They'll give you a mortgage.
They'll give you better interest rates.
Yes, that's right.
On anything that you're borrowing, and
use that as the swagger in your credit meeting. So
perfect.
Yeah.
Good. Well, thanks so much for joining me today.
Very happy to be here.
Yeah, appreciate it. And we'll get you back on at a later date and get you back in here to talk about some perhaps cash strategies and different things we can talk about. So thanks so much for joining me, and thank you for everyone for watching again today. We'll see you again next week. Bye-bye.
Thanks. Bye-bye. No.
Almost.
Ba-da-ba-ba.
There we go.